Hi folks, Rick Wedell here. Today is Tuesday, August 4th, and I thought I'd come to you with a brief update on what's going on in the markets. The S&P 500 is about 3290 as of this afternoon. That's basically unchanged. It's essentially flat. And essentially what's been going on over the past week, 2 weeks, is that earnings have been coming in way better than feared for the second quarter. So expectations for earnings coming into the second quarter were about minus 45% year over year. And with about 312 companies in the S&P 500 reporting as of yesterday, those actual earnings numbers were only down 10.4% year over year. So dramatically better than feared. As we've talked about previously on prior market updates, the market is obviously very forward-looking and thinking about what 2021 looks like instead of where we've just come from. But I think it's very important to understand that it's much easier for a company to bounce back and grow off a 10% earnings drop than it is for it to bounce back and grow off a 45% earnings drop. So market's taking a lot of positive sentiment from that. On the flip side, there's a little bit of nervousness over the political process in Washington over a second round of stimulus. Obviously, if you've been following the news, the Republicans would like to see about $1 trillion program, whereas the Democrats have a number that's a little bit larger than $3 trillion in mind. And where the rubber meets the road between those two parties has yet to be determined. It seems to be taking a frustratingly slow time. And there's a little bit of nervousness about expiring unemployment benefits and some other payments that may flow out of the economy while the politicians wrangle over the proper solution. I would just say that the pressure seems to be mounting, and so I think we will get a deal. Timing's uncertain, but it seems likely that both sides want to get something done here. On Thursday, we got unemployment numbers, and those are always interesting. It'll be interesting to see how the recent uptick in virus cases, particularly across the Sun Belt, has impacted those unemployment numbers, as some states have had to put a little bit of their reopening programs on hold. And then we'll also get payroll data on Friday, which will be interesting. That's it's sort of an employment report as opposed to an unemployment report, but good news on jobs, or at least news on jobs here at the end of the week that the market will take a cue from. With that said, I thought we'd take a little bit of time here at the end of the update to just talk about where we are year to date for most of the major indices. It's important to note that as of today, the S&P 500 is up about 3.2% for the year. But that's really masking a lot of what else is going on in the marketplace. The return for the S&P 500 year to date has really been driven by a lot of strong positive returns in the mega cap tech names, the big growth names, those online companies that are doing very well despite the shutdown and maybe even do better with the shutdown. So think about a Netflix or an Amazon. And with the rest of the economy sort of still continuing to struggle. So if you were to break the S&P 500 down into what we call our growth companies, which are those big techie high growth names, and value companies, which are more traditional industrial type companies, you'd see that the growth companies are up about 16.5% this year. And the more traditional industrial companies are down about 11, close to 12% year to date. So it's important as you look at your statements and you start to think about what you own, to think about that breakdown between growth and value, between big tech and traditional industrials. That's not something that we expect to persist over time. Eventually we'll see mean reversion between those two groups. But it's important to note from an overall portfolio composition mix for the year. The other thing that I would note is that small caps, which tend to be a lot more focused on those industrial type companies, are faring not super well relative to the S&P 500. So they're down about 8.5% for the year. And international markets as well. So whether that's Europe, whether it's developing, pretty much anywhere outside the United States, those markets are down on average about 5.5% across the globe. So it's important as you start to think about your statements to just know that the one shining bright spot in the world right now is U.S. large cap tech. And everything else has been, while not drowned dramatically, is still suffering from the recession in earnings that we've seen so far in Q1 and Q2. So with that, if you have any questions, as always, please feel free to reach out to me or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.